We are starting a new topic today. The topic is divisional performance evaluation. Under this topic, we shall be discussing how to evaluate the performance of divisions within a company. We shall look at what is divisional structure. What are the benefits of operating your business along divisional structure? What are the risks involved? How can we minimize the risk involved in divisional structure? We now look at how to evaluate the performance of division. To appreciate the topic we are about to treat, let us look at companies like Dangote, companies like USC, companies like John Oates. These companies are operated along divisional structure. Take Dangote, for example. We have Dangote groups of companies. Under the Dangote groups, we have Dangote Cement, a division within Dangote company. We have Dangote Salt, Dangote Sugar, Dangote Spaghetti, Dangote Drinks and Fruits. We have Dangote Transport. Currently, we have Dangote Petrochemical. Dangote groups of company is made up of 6 divisions. Dangote Cement, a division under Dangote Group. Dangote Sugar, a division within the Dangote Group. Dangote Salt, Dangote Spaghetti. These divisions belong to the same company, Dangote groups of companies. The total profit of Dangote, the total profit of Dangote groups of companies is profit contributed by Dangote Cement, Dangote Salt, Dangote Sugar, Dangote Spaghetti, Dangote Transport, and Dangote Petrochemical. The group profits is contributed by all the divisions. Now the question is, how do we evaluate the performance of individual divisions within an organization? That is the topic we are looking at tonight. How to evaluate the performance of divisions within a company. Our first discussion. What is divisionalization? Divisionalization can be defined or described as the decentralization. It involves decentralization of decision-making powers to the various divisions. Hence, division achieve some level of independence. A divisional company is one whose organization and operations are segmented along divisional structure. A divisional company, a company whose operations and organization is operated along divisional structure. Each division is regarded as an independent company with its own core business. Each division will be classified as an independent company with its own core business. Dangote Cement, the core business is cement manufacturing and sales. Dangote Sugar, the core business of Dangote Sugar is to manufacture sugar and sell sugar. Sugar manufacturing is different from cement manufacturing. Each of the division specializes in its own business. What are the objectives or what are the benefits of having your business along divisional structure? What are the objectives for operating business along divisional structure? One, to ensure goal congress, or what we call goal alignment. Number one objective is to ensure we have goal alignment. What does that mean? Take just 1 minute. When we say goal alignment or goal congress, the objective of the divisions must align with the objective of the company as a whole. The objectives of the various divisions must be in line, must align to the objective of the corporate head office. That is the group company. Dangote group of company. The primary objective is to make profits. Hence, Dangote cement objective must be to make profits. Dangote sugar objective is to maximize profits. Dangote salt objective is to maximize profits. There must be goal alignment. Number 2, to increase motivation of management by giving management independent power to make decisions. By allowing management, the management of each division is allowed to take decision independently. This will increase motivation. Number 3, to reduce head office bureaucracy, meaning that divisions should not rely on head office for decision making. If you have to come to head office all the time for decision, that could create bureaucracy, delay in decision making. Divisional structure will help us to reduce head office bureaucracy. Number 4, it provides better training ground for junior and middle level managers. Just 1 minute. Let's go on. Just to take water, please. All right. Divisional structure provides a training ground for junior and middle level management staff. You can train yourself from division. And lastly, to improve strategic decision making by operating your business along divisional structure. It enables divisions to improve its decision making. For example, Dangote Cement, you can focus on your business, cement decision making. Dangote Salt, the manager will focus on salt decision making, and so on. What are the risks? Or what are the disadvantages of divisional structure? One, suboptimality. The major limitation The major limitation of divisional structure is that there is the potential for suboptimality, the potential for dysfunctional decision making. There is the possibility of dysfunctional decision making, whereby divisions make decisions that are not in the best interest of the company as a whole. A division can be taking decisions that only favors the division, but that decision is not in the best interest of the company as a whole. That is dysfunctional decision making. Number 2 problem, increased overhead costs. If you operate your business along divisional structure, this will give rise to duplication of common functions, where a company is operated along divisional structure. This will give rise to duplication of common functions. Duplication of common functions will lead to increase in overhead costs. Please, you may mute so as to avoid external interference. Please check your speaker. Adedolapo. Let's continue. Where you run your business along divisional structure, there could be duplication of functions, common functions. What are these functions? HR function. HR function is duplicated. For example, Dangote Cement has its own HR department. Dangote Salt has its own HR. Dangote Sugar has its own HR. You now have you have like 6 HR departments in Dangote company. This is duplication of common function. This will give rise to increase in overhead costs. Number 3 problem, loss of control. Loss of control. Another argument against divisional structure. Another argument against divisional structure is that top management, by delegating decision making to divisional managers, loses control. Once you delegate your power to divisions, the top management at the corporate head office may lose control of the divisions. Since they are not aware of what is going on in the various divisions that make up the organization, that's a problem. That's a risk. You always ask me this question. Mr. Joseph, what page? Please just go to you have the material. You have the contents. Go and look for divisional structure. And open to it. That your material. I didn't look at it. So please refer to the material, check the contents. The content is there. Please, just 1 minute. No dulling. All right, sorry for that. Let's continue with the class. Now we have discussed the benefits of divisional structure. We have discussed the risk involved. Our next discussion is, how do we manage this risk? How do we minimize the risk involved? The problems highlighted above can be addressed by introducing a suitable system of performance evaluation to minimize the problems associated with divisional structure. The company's management must introduce an appropriate system of performance evaluation. The performance evaluation should be able to achieve the following objective. Management must introduce appropriate performance evaluation method. The evaluation method should be able to achieve the following objective. The evaluation method must promote goal alignments. The performance evaluation method must encourage initiative and motivation. The evaluation method must be able to provide feedback to management. And the evaluation method should consider long-term objective of the business rather than short-term view. What that means is that we must not consider profit only. If you are trying to evaluate divisional performance, we don't consider the profits. We also consider the long-term survival of the divisions, the ability for the division to continue to grow and remain relevant in the longer term period. All right. These objectives explained above can only be achieved with the introduction of responsibility center. The objective we have itemized above: promoting Go Congress, encouraging initiative and motivation, providing feedback to management, encouraging long-term view. You can only achieve this objective by introducing responsibility centers and responsibility accounting. What is responsibility center? What is responsibility accounting? Let us start with responsibility accounting. In responsibility accounting, a specific manager, a designated manager, is given the responsibility for a particular aspect of the company's budget. A designated individual is given the responsibility for a particular aspect of the company's budget. And within the budgetary control, the manager is made accountable for the actual performance of the task. I will take that again. Responsibility accounting. A designated manager is given the responsibility for a particular aspect of the company's budget. And within the budgetary control system, he or she is made accountable for the actual performance. Managers are made accountable for their areas of responsibility. That is responsibility accounting. For example, you have your specific job function in your office. Individual staff, we have his or our own job function. That your job function that is assigned to you, and you are made responsible for the actual performance of that function. If anything goes wrong, you'll be held accountable for that job assigned to you. That is responsibility accounting. In the organization, all job all jobs must be assigned to specific individuals. You cannot do all jobs. You must have your own specific job function. That job function for which you are responsible is what we call responsibility accounting. You are going to be held accountable for the performance or non-performance of that job. Responsibility center, the area of operations for which a manager is responsible, is called responsibility center. The area of operations for which a manager is responsible is called responsibility center. For example, you have the sales director. The sales director is in charge of the sales department. That sales department is a responsibility center. The sales director will take responsibility for sales, for the sales of the company's products. We have purchasing department. The head of the department is the purchasing manager. That manager is responsible for the purchasing activities of the business. That manager is responsible for the purchasing activities of the company. That purchasing department is a responsibility center. According to CIMA, responsibility center is defined as a department or organizational function whose performance is the direct responsibility of a specific manager, according to Chartered Institute of Management Accountants. A responsibility center is a department or organizational function whose performance is the direct responsibility of a specific manager. In the weakest form of decentralization, a cost center is a responsibility center. That is the weakest form. But you can stop here. A department or organizational function whose performance is the direct responsibility of a specific manager. Responsibility center can be categorized into 3 or 4. Types of responsibilities centers. One, cost center. A cost center is a department or section or function. And this department a cost center is established only to incur cost. A cost center, department that is established such center cannot generate revenue. A good example of a cost center is admin department. A good example of a cost center is admin department. That department is only to generate, is only to incur cost. Please note, a division cannot be a cost center. For you to qualify as a division, you cannot be a cost center. Number two, profit center. A profit center is a business unit or a business segment that is allowed to generate revenue and incurred expenditure. A profit center is a business unit that is allowed to generate revenue and incur costs. Periodically, the center will report the profit achieved. The manager in a profit center, the manager in a profit center will be held accountable for the profitability of the operations within the profit center. Please note, a division can be a profit center. A division can be a profit center. That means division can generate revenue and incurred costs. Periodically, division will report the profit or loss achieved. Hence, divisional manager will be held responsible for the profitability of the operations in that division. Please note, a division can be a profit center. Number three, investment center. An investment center is a center that is allowed to generate revenue and to incur cost. In addition, the center is allowed to make investment decisions. An investment center is a business unit of the organization that is allowed to generate revenue and incurred costs. In addition to this, the investment center is given the authority to make investment decisions. Investment decision on non-current assets. Periodically, the profit of the division, the profit of the center can be related to the amount of investment made. You can relate the profit of the center to the amount of investment made in the center. Please note, division can be an investment center. A division can be an investment center. Number 4, revenue center. Number 4, revenue center. A revenue center is a department or a section that is allowed to collect revenue. Is established only to collect revenue. The revenue center cannot incur costs. It can only generate or collect revenue. The revenue center managers only require information relating to revenues. Such center can only collect revenue, and they will be made accountable for revenue collected. Please note, a division cannot be a revenue center. A division is not qualified to be called a revenue center. If that department is established only to collect revenue, that department is not qualified to be regarded as a division. Our next discussion: how to evaluate the performance of division. How can we evaluate divisional performance? All right, I'm trying to expand this. We have financial performance measures. We have the financial performance measures. You can use financial measures to evaluate the performance of the divisions. You can use financial measures to evaluate the performance of division. This performance measure includes 1, return on capital employed, or what we call return on investment. You can use return on capital employed to evaluate the performance of division. Return on capital employed is calculated as operating profits divided by capital employed multiplied by 100. Your return on capital employed can be calculated as your operating profit. Operating profit is profits before interest and tax divided by the capital employed. Your capital employed, let me take my pen. Our operating profits is equal to profits before interest and tax. Our capital employed is equal to total assets minus current liability. Or you can compute as your capital employed so let me move it back a bit. Capital employed is equal to shareholders' funds. Shareholders' funds plus long-term debt. Both methods will give you the same results. So you can evaluate performance of division using return on capital employed. Number 2, you can do residual income method. You can what is residual income? Residual income is the operating profits less the cost of capital employed. Our residual income is the profit in excess of cost of capital employed. The idea behind this computation or this method is that a company should be able to generate enough profits to pay returns to the providers of capital. The basis or the concept of this residual income method is that for you to say a division is doing well, or for you to say a company is performing well, that company must make sufficient profits to be able to pay returns to the providers of capital. Who are the providers of capital? Equity shareholders and the debt holders. In other words, we should be able to make enough profits. We should be able to make enough profits to be able to pay returns to the providers of capital. That is the concept of residual income. It's also similar to, is slightly similar to return on investment, but that is based on percentage. A company should be able to generate enough profits to meet the expectations of these providers of capital.
Everywhere is stop.
Please, can you mute Mr. Joseph?
Oh. Sorry, sir.
To compute residual income, the formula is operating profits minus, open a bracket, capital employed multiplied by the cost of capital. Capital employed multiplied by the cost of capital. Your capital employed multiplied by the cost of capital is called notional interest or imputed interest. You must have enough profits to meet the cost of capital employed. Any of these can be used to evaluate the performance of division. We also have economic value added, but we are going to keep that in next week. We also have economic value added as a measure of divisional performance, but we are going to keep that till next week. Let us apply question to what we have learned so far. Okay. Precisely page 84, illustration 2. Please refer to page 84, illustration 2. Let us start with this question. Page 84, question number 2. Page 84, question 2. Let us start with this question tonight. All right. Are we good to go, please? Are we good to go?
Yes, sir. Yes, sir.
Mr. Governor.
Yes, sir. We are good to go, sir.
Right.
We are ready, sir.
Examiner say define the following concepts: responsibility accounting, investment center, return on investments, and residual income. What is responsibility center? Any opinion? In 1 minute. Yes. What is responsibility center in 1 minute? The class is silent. Who can define responsibility for us? Right, let's see. You can send in your comments. Somebody said, that one is too simple. That's why we are silent. Okay. What is investment center? Define return on investments. What is residual income? So I'm assuming that these are simple questions. Why wasting our time? All right, the B parts. Ingerige and Son. Limited. As for operating divisions, which are spread in 4 cities in Nigeria: Lagos, Kano, Gombe, and Enugu. These divisions are treated as investment center for the performance reporting. The following information is available. You have the particulars: Lagos, Kano, Gombe, Enugu. Divisional investments, divisional sales, divisional variable cost, and divisional fees cost. Next. The company's annual fees cost is 1.3 million, which is apportioned to the divisions on the basis of sales. The cost of capital of Ingerige and Sons Limited is 7.5%. Ignore taxation. Requirements A1. Evaluate the performance of the division using return on investment method and residual income method. Let us go to this. Examiner says, evaluate the performance of the divisions using 1. A1, evaluation of divisional performance using return on investment method. For me to do this, what is my formula? Return on investment is calculated as profit before interest and tax divided by investment amount. That is the capital investment. That is the capital employed. Your investment amount is the capital investment. Investment amount multiplied by 100. That means I need to get the operating profits. In the question, you have divisional sales, you have variable cost, you have fixed cost. That means I need to compute my operating profits, the profits before interest and tax. We now come here. You have Lagos, Kano, Gombe, I have to shift this. Lagos, Kano, Gombe, Enugu, and Total. The company as a whole. Start with sales. The sales value. For Lagos, 53 million, 23 million, 24,600, 29,400. This is 53,000. Assuming 30 up, 23,000. 24,600. 29,400. Please, can we sum up? Assuming we have 40 up, assuming we have 40 up,
$130,000.
Thank you, sir. My sales value. Yeah, I have 30 up, 30 up, 30, 130,000. Next, your variable cost. Let's go to it. 50, 22, 23,400, 27,400. $50,000, 22, 23,400, 27,400. Please sum up your variable cost.
122,800.
Divisional fees cost. Divisional fees cost. The fees cost incurred by the division.
Lagos 15.
1,500, 75. Okay, if you have the figure, give me.
Lagos 15.
All right, thank you, sir. 1,500.
750.
750 Kano.
750.
600.
600.
Then 800.
800. Please sum up the fees cost.
It's 1429. 3,650. 3,650.
3,650. We now have apportioned head office cost. Look at the paragraph next. The company's annual fees cost is 1.3 million, which is apportioned to the divisions on the basis of sales. This fees cost is incurred by head office. For the whole company, we are going to share this cost on the basis of sales to the various divisions. You now come here, a small working, can take the working here. Calculation of head office fees cost apportionment rates on sales basis. On sales basis. Look at it. That is total head office fees cost divided by total sales. Let's go to this. Total head office fees cost 1.3 million. Total sales 130 million. Can come here. 1,300,000 divided by 130 million. What is the apportionment rate? 0.0 what?
0.1.
0.01. Is this correct?
Yes, sir.
Per what? .01 per sales.
Per sales.
Because we are going to apportion on sales basis per sale. You can now apportion now. Working next. Apportionment. The apportionment of head office fees cost. I have Lagos. The sales here is 53,000 multiplied by 0.01. I have Kano. The sales here is 23,000 multiplied by 0.01. I have Gombe. The sales is what?
24,600. 24,600.
Multiplied by 0.01. Gombe. I have Enugu. The sales is
29,400.
29,400 multiplied by 0.01. This will give me
Lagos is
530,
3,000. Okay.
230, 246,
And 294.
If you sum up, it must give you 1,300. So I have 530, 230, 246, fixed cost apportion, 294, totaling 1,300. You can get your profit before interest and tax now. That is your operating profit. Profit before interest and tax. Look at it. Revenue minus variable cost minus divisional fees cost minus apportioned head office cost that will give you your profit before interest and tax. Please, can we compute?
For Lagos, 970.
970. $20. $354.
Enugu, 906.
And yet 906. So the company as whole, 2,000 watts.
2,250.
2,000.
2250. 2,250.
You have gotten your PBIT. Look at the formula. PBIT divided by the investment amount. Now go to the question. Pick the investments. Divisional investments. 10 million, 4 million, 3 million, and 7 million. I'll come here. Investments, 10,000, 4,000, 3,000, 7,000. Total investments, 24,000. You can now compute return on investments. $970 divided by 10,000 multiplied by 100. 9.7%. Next. $20 divided by 4,000.
0.5.
0.5.
5. 11.8. 11.8.
11.8%. 906 divided by 7,000.
12.9%.
12.9%. For the company as a whole, 2,250 divided by 24,000 multiplied by 100.
That's
9.4.
9.4%.
Approximately
9.4.
9.4.
9.4. We have answered the first part. Evaluate performance using return on investment. If you check this out, Enugu division is the best division in terms of return on investment, followed by Gombe, followed by Lagos. Kano is not doing very well, 0.5%. That is small. A2, evaluation of divisional performance using residual income method. What is the formula for residual income? Residual income is equal to profit before interest and tax minus, open a bracket, capital employed multiplied by cost of capital. You have stated your formula. Your formula will guide you. I require profit before interest and tax. You have Lagos, we have Kano, we have Gombe, we have Enugu, and the total company. Then pick your profit before interest and tax, 970, 20, 354, 906, 2,250. Next. Capital employed multiplied by cost of capital. Let us show this working. Working 2. All right. My working 2. You have capital. Your capital employed is the investment amount. Investment amount multiplied by cost of capital. Let me do it straight. So multiply by cost of capital. I have Lagos. Investment amount 10,000. Cost of capital 7.5%. Kano. Investment 4,000 multiplied by 7.5. Gombe. Investment 3,000 multiplied by 7.5 cost of capital. Enugu. Investment 7,000 multiplied by the cost of capital. Please work this out.
Lagos is 750.
How much here?
Kano is 300.
How much here?
Gombe is 225.
Total investments. What is Enugu?
Enugu is 525.
525. Total investment 24 million. At 7.5. Total year should be 1,800. You can return up. This is 750. We are going to deduct it. 300. This is 225. And this is 525. The total is 1800. You can get your residual income now. Residual income 970 minus 750.
220.
220 negative 280
129.
129.
Gombe. 129 for Gombe.
129
And 381 for Enugu.
381. We have gotten our residual income. Enugu is still the best division. Kano, obviously, Kano is doing badly. Kano division does not have sufficient profit to pay returns to the providers of capital. Kano division is doing badly. All right. Any question, please? If there's no question, requirement B. Examiner says reevaluate the residual income situation of the company, given that cost of capital is now 10%. Examiner says reevaluate residual income situation of the company as a whole. Assuming cost of capital is now 10%. We now come here. I have this space here. I have this space here. This space here. This space here. One more. All right. B pass. Reevaluate the residual income situation of the company assuming cost of capital is 10%. Look at it. The residual income, ROI, you pick the company's total profit before interest and tax. Pick the company total profits. Look at it, 2,250 minus, open a bracket, the total investment by the company, 24,000. That is the total amount of investment the company has made on the various branches. Multiply it by 10%. Our residual income is equal to 225 minus 2250 minus 2,400. What is the residual income here?
Minus 150. Negative 4.
Negative 150.
150.
That means if the cost of capital is increased to 10%, the company will not be able to meet returns to the providers of capital. If the cost of capital is increased, this company will not be able to meet returns to the providers of capital. We are done with the question. We are done with the question. Any question, please? Oof. If there's no question, please refer to the next question, question 4. Oh, where is it? Question 4. That should be page 87. Or 88. Illustration 4. Carosi Limited. Yeah, look at this question. Will you call it faster? Yeah, Carosi Limited. That should be page 87, 88. Illustration 4. We can treat this in 30 minutes. Are we good to go, please? All right. Let's go to this quickly. Carosi Limited makes quality wooden products such as table, chairs, benches, and doors. Historically, the company has used many financial performance measures to assess the performance of the company as a whole. The company's chief executive officer has just been informed of the balanced scorecard approach and is eager to learn more. Carosi Limited has two divisions, X and Y, each with its own cost and revenue stream. Each division is managed by a divisional manager who has the power to make all investment decisions within the division. The cost of capital for both divisions is 15%. Historically, investment decisions have been made by calculating the return on investment of any opportunities, and presently, the return on investments of each division is 18%. Presently, the return on investment for both Division X and Division Y is 18%. A recently appointed manager for Division X strongly feels that using residual income is to make investment decisions will result in better goal congruence throughout the organization. Next paragraph. Each division is currently considering the following separate investments: Division X and Division Y. Division X and Division Y. Capital required for investments is given for both divisions. Revenue generated from the investment is given, and we are giving the net profit margin. Next, the company is seeking to maximize shareholders' wealth. Requirements 1. Describe the balanced scorecard approach to performance evaluation. What is balanced scorecard? Approach to performance measurements. Look at the explanation. The balanced scorecard is a strategic management tool used to measure organizational performance from 4 different perspectives. A balanced scorecard is a strategic management tool used by a company to evaluate performance under 4 perspectives. The 4 perspectives of the balanced scorecard are explained below. 1, financial perspective. This measures financial performance, such as revenue growth, profitability, return on investment. Financial performance or financial perspective. A company must be able to achieve, a company must have a strong financial perspective. Even human beings, we should be able to perceive that company in terms of strong financial base. Investors, customers, and the buying public should be able to perceive us financially strong. Number 2, customers' perspective. How do customers perceive our company? Customer perspective is very key to business success. How the customer perceive your business? How the customer perceive your company? We have impacts on your revenue generation. Customer perspective measures include customer satisfaction. To what extent are the customers satisfied with our service or products? Customer loyalty, customer retention. How many customers will buy our products and will be willing to buy and make a repeat purchase? We must be able, our company must be positively perceived by the buying public. Number 3, internal processes. The internal processes perspective. This measures the efficiency and effectiveness of our internal process. That is, what is our strength? What must we excel at if we are to gain customer? Where does our strength lies? We must look at the internal process perspective. This will have impact on our operational efficiency, quality of our service. What is that thing that we are good at, that we can do exceptionally well as a business organization, even as an individual? You must be able to identify that thing you can do exceptionally well. It is that thing you are going to sell to make profits. Individual company has their strengths. For example, the banking sector. Zenith Bank has its own strengths. What the bank can do exceptionally well. GT Bank has its own strengths. What the bank can do exceptionally well. That thing that you can do extraordinary well, that is where your strength lies. And that is what you are expected to focus on if you are to attract customer to yourself. Number 4, learning and growth perspective. Business organization must have the ability to learn, innovate, create, and improve its processes. You can look at the benefits of the balanced scorecard. All right. Let me look at the last 2 questions. Requirement B. Examiner says, determine both return on investments and residual income of the new investments of each of the division. We start with division X. Division X, calculation of return on investment and residual income. Return on investment formula, operating profits divided by capital investments multiply by 100. Go back to the question. We have the net profit margin. Your net profit margin is profit as a percentage of revenue. In this question, we are not giving the profit directly. We are not giving the profit in absolute terms, but we are giving in percentage terms. Net profit margin. That will represent profit as a percentage of revenue. Then our investments, 88.2. Revenue generated for division X, 46.4. I can return here. Oh. Oh. All right. For division X, profit is equal to 30% of revenue. The revenue here is 46.4 million. Please compute the profits.
That's 13,920.
13,920. 13 points what, please?
13,920.
How do you get that? Half?
Okay, no. I put it 46 points.
Just follow the examiner way now. 13
Okay,
points what?
92.
Examiner gave you in point. Just move the examiner now. 13.92. Capital investments. Capital investment for division X. Examiner say 88.2 million. Therefore, return on investment 13.92 divided by 88.2.
That's 15.8.
I have 15.8% multiplied by 100. You have gotten return on investment for division X. Let us compute residual income for division X. Residual income is equal to profit minus bracket investments multiplied by the cost of capital. Residual income, the profit is 13.92 minus investment is 88.2. Cost of capital is 15%. Let's check that out. Look at it. The cost of capital for both divisions 15%. Oh, multiply by 15%. Please work this out. What is the residual
That's
income? What do you have?
that's a 0.69.
Thank you, 0.69 million. You are done with division X. We now go to division Y. Division Y. Calculation of return on investments and residual income. We start with return on investments. We need to get the profits. Profit for division X, 35% of revenue.
Revenue is 28.1.
Please compute 35% of 28.1.
9.84.
9.84 million. Capital investments for division Y. How much, please?
That's 46.0
million. Therefore, return on investments.
times 100.
This is
That's
equal
21.
to. Yeah, I'm still going to show the
21.
working. Go ahead, don't worry.
21.4.
21 point what?
4. Approximately.
9.84 over 46.0 multiplied by 100. 21.4%. Then residual income for division Y. It becomes the profits 9.84 minus, open a bracket, capital invested 46 million multiplied by the cost of capital 15%. This will give you residual income for division X. How much here?
2.94.
2.9. 4 million. All right, let's do a summary. Summary. We have division X and division Y. Return on investments 15.8, 21.4. Residual income 0.69 million. 2.94 million. Let us look at the last requirements. Comment on these results and take into consideration the manager view about residual income. What is the manager view? Okay, look at this. Look at this paragraph. Starting from here, historically, investment decisions have been made by calculating return on investment of any opportunities. And presently, the return on investment of each division is 18%. Next, a recently appointed manager for Division X strongly feels that using residual income to make investment decisions would result in better goal congruence throughout the organization. Comment on the view of the manager and comment on the results. Look at the results. Currently, both divisions return on capital employed is 18%. Now look at this now. The two divisions, they have a new project they are considering. We are now trying to evaluate the two projects. If we use residual income, if we use return on investments, Division S will achieve 15%, 15.8%. And currently the division is achieving 18%. Currently, Division X is achieving 18%. Oh, this thing is disturbing me. Currently, Division S is achieving 18% return on investment. You now have a new project that will give you 15.8%. The question now is, will Division X be willing to accept the new project? On the basis of return on investment, would Division X be willing to accept the new investment? Obviously, the answer is no. Currently, I'm earning 18%. You now invite me to a project that will give me 15.8. I will not be motivated to accept that project. But if you use residual income method, the project will generate a positive residual income. That means the project is financially viable. And that was the argument of the new manager. The new manager says it is better to evaluate investments on the basis of residual income. Because it aligns, it promotes goal alignment. It promotes goal alignment. That will be the comments in requirement C. That according to the new manager, residual income is a better method of evaluating investment because it promotes goal alignment or goal congruence. Unlike the return on investment, we are done with the question. We have been able to address 2 questions. That's a good one. So your comments. Let me just write small thing on the comment section. C. If the project is evaluated on the basis of return on investment, division X we most likely reject the new projects, the new investments, because the calculated return on investments of 15%, 15.8% is less than what the division is currently earning on its investments, in brackets 18%. But If the project is assessed on the basis of residual income method, division X we accept the new investment because it has a positive residual income. This shows that the view expressed by the new manager of Division X is correct. Residual income results in better decision making. And promotes go congruence. You can stop here. For Division Y, whether residual income or return on capital employed, Division Y we accept the project. All right. We shall stop here tonight. Any question, please?
Well done, sir. Well done, sir.
Yeah, Mr. Magaji.
Yes, sir. You have done well. Remember to drop the notes and the video for us, the recording.
All right, the notes will be dropped immediately after the class. But the recording, there's an officer that will do that. That will be tomorrow morning or tomorrow, 24
Okay, sir.
hours
Thank you.
after the lecture.
Okay, thank you, sir.